Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Welcome back to Wealth Unfiltered. This episode is about maximizing your ROI and why multifamily developments outperform. So this week, we're very excited. We have a special guest on, Michael Holman. He is the VP for Overland Group, and we took some time to ask him some questions, and we're really, really grateful that he took the time to meet with us for this special podcast. My name is Samantha Parinello, and I am the host of the show. I'm here with my resident guest expert, Chris Parinello. Welcome back.
Hey, everybody.
Awesome. So we're going to dive into multifamily development. Specifically, Viking has always been acquisitions, so thus far. And it's not because we don't think that multifamily development has been something that we should be a part of. It's because we really had to vet the right partnership. And so I know that finally when the synchrony of having the Overland Group be a part of us, we launched our development project about maybe 5 or 6 months ago. And I would like you to kind of give some, background on that, as well as like where we are currently in this project. And then we can really dive into overall development deals as a whole.
Yeah. And, to give some background on, the Viking Capital and Overland partnership, we had been looking for an opportunity to work with this particular developer for the last couple years. And we'll talk about entitlement risk later. But the original deal that we were planning on doing with them about 1.5 years ago had some unexpected entitlement risk where a piece of land was zoned for multifamily, but then deep down in the records, when people in the area were not happy about the development, they found a loophole to get it rezoned and take away the ability to build multifamily there. And it kind of torpedoed the deal, which is a form of entitlement risk, which I'm sure we'll get into the risk factors of development later on. But we're thrilled to be working with Michael and his family that owns the company. They're based in Salt Lake City. They have done tons of these deals. I think they're on like their 50th or 60th development. They do 8 or 9 of them a year. And
which they also have some in Phoenix already, which
Correct.
We were able to go walk on the property.
Yeah, Phoenix, Salt Lake City, and I think they're even doing one in Vegas right now. They're a mid-sized group with their own construction arm that is in-house construction management that is just growing just as rapidly as Viking.
That's so amazing. Yeah, well, thank you for the background and context. So let's talk about how we launched the deal previously and then where we're at with the development deal now.
Yeah, so with any development deal, you have a little bit more of a runway, and there's advantages and disadvantages to doing, a development deal if you're used to doing primarily acquisitions. But one of the things that we've been trying to tighten up and figure out is when to actually launch. Like we found out in that previous deal. Entitlement risk is something that we try our best not to take. And that means buying a property that's zoned for retail or zoned for office and trying to get it re-entitled into multifamily.
Right.
That, provides a pretty heavy risk. So we like to start with a developer that owns the land already has the land fully entitled, that has the plan to build, pretty fully baked. And then there also needs to be some opportunity in the market. We need to like the geography. We need to like, the general business plan and how we feel about, the overall project.
Right. Continue though about ours.
So Peoria Gateway is a project that, like Samantha mentioned, is in a growth market. And if you're familiar with the Phoenix area, think, Scottsdale, think, some of these other
Glendale.
Mm-hmm. A lot of the submarkets around Phoenix have already popped significantly with lots of supply. Peoria is one of those areas that's like right on the border of some of those areas that have popped, but is still just beaming with opportunity. And this is going to be one of the first, really nice Class A modular style buildings with townhomes that's in that area. And it's gonna, I think, 2, 3 years down the road when we're going to be selling this property, it's going to be entering into a market without a lot of competition and supply.
Right. And one of the big things about Phoenix as a whole is that it's seeing tons of migration. I mean, the demand
Yeah.
is rapid, especially from areas like California. For
Hmm.
people who want the cost of living to go down, but still kind of have that lifestyle, be close enough to Scottsdale that reminds them of places, in California. So I think that's definitely a huge selling point as well, that the demand is there. And this specific area, like you said, isn't seeing the same construction boom, and it's something that's
Right.
on the path of progress. It's definitely something that we're going to continue to see the growth trajectory as it continues to unfold.
Yep.
So we have, like we said, we had first basically brought this deal out, back in, I want to say May or maybe just after May. I think it's been so long now, but you and I were actually visiting Arizona.
Yeah.
We're in Phoenix, and we walked one of the properties that Michael Holman was already constructing. It's very similar. It has the same type of model, that this one's going to have. And we went and saw the plot of land, but obviously at the time it was just land. So there wasn't a
Yeah.
lot to see for this specific project, but it was really cool to see the progress and kind of what the future holds for our development deal.
Yeah, I mean, anytime you get to walk on a site that's half built, and put on a hard hat, and see exactly how they're building the building, it's definitely gets a little bit more exciting than walking through a fully built property. Being able to sit down and talk to the developer, look at the plans, kind of understand the vision, and then our property, while it was just a piece of land, you can kind of see what it's going to transform from. And you kind of see what has kind of popped up around the area. Like they built like a performing arts center, like right around the corner. You saw some retail that was going to get demolished, and the whole area is kind of gentrifying, and it's going to be building around this development. This is going to be kind of the anchor for the area. In addition to that, I think what I really liked about the deal was Michael's owned this land, or his Overland Group's owned this land since I think 2018. So they had a ridiculously good basis on the land. Whereas if you tried to purchase it today, it'd be a lot more.
Oh, absolutely. Yeah. So one of the things that we discussed is how is traditionally an acquisition company, and now we're doing a new development. So what I'd like you to kind of specify for our listeners is, what is the difference, the main differences between an acquisition and a development deal?
Yeah, and I mean, I think the big things that you want to look at, no matter what you're investing in, is kind of understanding where the risk is. I think that's first. Then you want to look at kind of the time horizon. So a development deal is traditionally going to be, 2.5 to 3 year hold. Could go longer if, it's not the right time to sell when you finish being built, like that Avondale deal we just closed on. Developer built it, tried to deliver it in 2022, decided to hold on to it for another couple years, let it cash flow, and try to sell it at a better time. So there's that kind of risk. Um, you're typically not going to get a lot of cash flow because you're not buying something that already has revenue. You need to build it and stabilize it before you're going to have revenue. So if you're a yield investor, construction's probably going to be a hard pill to swallow.
Hmm.
Um, One of the other nuances is a lot of the folks that invest with Viking do so for depreciation
Hmm.
and being able to offset passive income. Development, it's not going to count as going in service until it's stabilized and is actually a rentable, apartment complex. So you're not going to get that depreciation that be able to get to accelerate until the year
Later
before
on.
you sell it, which
Right.
you'd recapture it the next year. It's less useful. But one area that is really advantage for development, in that land value, we're able to take 1031s. So that land value's owned, and we can bring up to $5 million in 1031s. The whole new subset of investors that have exited multifamily properties, either as a group or, even if somebody's owned like a duplex or strip mall or something, and they've sold it and they're looking to 1031 money into another commercial real estate asset. This is a really nice fit.
And this is the first 1031 that Viking's been able to offer.
Yeah, well, we've had a couple that we've tried to structure, but they were acquisitions, and it's a lot more moving parts. With a development deal, what the 1031 folks are buying into is we're setting up a tenants in common structure, and they're actually being put on title for the land. So with doing a 1031 deal, the folks are actually being put on title in the ownership of the land, and then they're carried into that portion of the overall broader project. So they get the returns for the overall project, but they've facilitated their 1031 before construction's even started. So it's a really nice way to just completely offset taxes. And then hopefully the goal would be to 1031 that money in to something else and continue rolling it forward tax free.
Well, and I've heard, so, obviously clear this up if I'm wrong, but one of the, advantages of a development deal is that you typically get higher returns than you do on an acquisition. Is that true?
Yeah. And then that's, it's just kind of goes with you're kind of giving up yield, but you're
Cash flow.
usually getting a much higher return, and in a shorter amount of time. So if you're
Right.
going to get, a 1.7 or a 1.8, I think in our model, we're showing a regular Class B investor with around a 1.8x return in 3 years. You're able to redeploy that capital, quickly into another deal. It's also a good foundational investment for somebody that maybe is first starting to invest in real estate because you're compounding money more quickly. And you're able to take that money and then reinvest your proceeds into other acquisitions or separate them out into several other deals.
Yeah, that's amazing. Yeah. So one of the things that I think we are really excited for Viking and our continued trajectory is doing more development deals.
Mhm.
And the way that we have talked about doing this is through having a person on our team who is very strong with this, and that would be our asset manager, Ed. So if you can go into a little bit of his background and then why we feel like this is another great, like this is our first one, but it is definitely not our last, and talk about kind of what our plans are for development and why we feel like it's a good move to bring this into the fold more often.
Yeah, I don't think it comes as a surprise that the person with the most real estate experience on our team is our asset management director. Ed's fantastic. He's been able to really manage the heck out of our portfolio and get the most out of these deals, especially deals that were facing adversity coming out of 21 and 22. But where his breadth of experience really lies is in development. And, most real estate people understand that to have a true all weather strategy, you need to have a component where you're able to not only acquire but develop. And the reason for that is when you look at the real estate cycle, a lot of times what you're trying to do, at least from a cap rate perspective, is buy when cap rates are high or expanded. Um, and you want to sell when cap rates are compressed. That's when you're going to get the most value, when there's the most demand for your asset to sell. Um, so what happens when your company's been around for 15, 20 years, you're buying a few deals, you're selling a few deals every year? What do you do when you get to that part of the market where interest rates are really low, cap rates are really compressed? You build, right? So that's the all-weather strategy. When you're selling your assets away and interest rates are favorable because construction properties use variable rate debt, times like now where interest rates are a little bit more elevated, like for the past year and a half, development deals have ceased to build. That creates a value proposition for acquiring and developing because there's going to be a couple year period where not a lot of units come on. Um, but if you're really looking at navigating the cycle well, what you want to do is sell when cap rates compress and then use those proceeds to develop, in my opinion. And I think that's why Viking's so excited about starting this vertical within our firm.
Yeah. So I've been doing a ton of research for my organic content that I put out for Viking, and one of the key fundamentals is how this the new supply starts is at a record low,
Right.
and we were just at a record high 2 years ago. But if you think about the cycle and the timeline for development, new development, you're talking about 2, 3 years. And so right now, 2024, 2025, we're going to see some of the highest number of deliveries to the fact that we had so many starts. Now, with what's going on with inflation and the cost of supplies and all of that, we're seeing a huge lull. And part of that is because we've partnered with a really strong development firm and our ability to continue the process and not have the holdups that everybody else is having. It's extremely advantageous to build right now because when inevitably the supply is low, the new development supply is low, we're talking about in 2 years from now, this is going to be one of the only new units that are coming up literally in the Phoenix area because of the fact of what's going on in the economy. So
Right.
please touch on more.
And I would even say, for argument's sake, I would say the majority of the new units that came on in 2022 and 2023, they were completed. And that means that they were taking advantage of the ridiculously low debt in 2019 and 2020, and they were delivering in 21 and 22. A lot of those properties, like our Avondale property, didn't even transact until 24. You're just now seeing developers that built and completed projects in 21 are starting to move off of some of those properties because it was looking bleak. It didn't make sense for them to sell those properties then.
Well, and then another key factor is that supply demand, right? And so one of the things that you see is there is this fear of how will this all be offset? But what we are finding is that multifamily as an asset class is being driven with demand. A lot has to do with the fact that the economy is so difficult that there's no chance for people to be first-time home buyers. Today, I read a statistic that the average first-time home buyer is now moved all the way up to a record high of 38, and the average person to have a secondary or third home purchase is at 58. I mean, these are both record highs, and it's all happening because of the inflationary environment that we're in. And we don't know when that's really going to change. And so as we see that, the demand for multifamily housing is going to continue to grow. And then you also have that extra piece that, the Gen Zers, the millennials are also choosing to rent because they want the flexibility. They don't want to be have a home where they want to travel more. And there's working from home. There's just so many different things that I don't think were happening even 2, 3 years ago. So the key fundamentals that are driving multifamily are actually strengthening.
Right. And that's exactly why you see us building in Peoria and not Scottsdale.
Absolutely.
So you're trying to kind of get out ahead of the path of progress. You're trying to find areas that do have demand for new, nice multifamily that might not exist in that area because you have people that are looking for more affordable rents, still want something nice. And I think that you've kind of hit the nail on the head with the value proposition.
Yeah. Well, and that's been another, thing too, is like the affordability gap is starting to widen and it's going to continue that way as right now, currently the wages are outpacing inflation. But as we see, the economy is going to get a little bit stronger and a little bit stronger with the rate cuts happening. And as that happens, I think we're going to see that gap start to go down and then affordability is going to have an issue again. So that affordability piece, because right now what's happening is that the wages are allowing people to continue paying rent. We're not seeing the vacancy rates be higher. We're not seeing the bad debt in the way that we did.
I would say that you're definitely seeing some softening in certain markets. You're definitely like we're seeing in our portfolio, like slightly higher bad debt. You're starting to see some like small cracks in the economy and pressure. But at the same time, the economy is showing that it's strong.
Right.
So I think people are feeling the pain from groceries being more expensive, their car payments being more expensive, interest rates staying high. You're seeing the effects of less construction because interest rates are high. Construction use variable rate loans. You're seeing the effects of less people acquiring multifamily, even though there's an attractive, cap rate environment. A lot of people aren't buying because they don't have access to equity. And they're only getting 60-65% LTV from the agencies. So you kind of see a slowdown, but what we have found is that if you can find a way to be flexible and think outside the box and get deals done when no one else is getting deals done, you have a better chance of getting your deals at work. If you're in like this crazy bull market where everyone thinks that it's easy to do deals, chances are you're going to get caught in a game of musical chairs again.
Right. So when we talk about development and your portfolio, why do you think it's important for every investor to minimally consider it, but probably have at least one development deal in their portfolio?
I mean, I would say that it's important for that reason that I kind of explained, kind of the all-weather strategy. If you're only going to invest in multifamily and say that's your thing, you're going to learn about it, you're going to study it, and that's what you want to do. There's inevitably going to come a time when the market's too frothy, and no matter how experienced a sponsor is, if you're buying at that time, you're buying at a really high basis, and it would probably make more sense to build or construct a deal. And when that happens, um, you're going to want to be prepared and have some experience with it. And the only way to get experience with it is to, in my opinion, if you're not going to build the chops to do the construction yourself, is working with a reliable sponsor and a reliable developer and kind of go through the process, see what kind of pitfalls, see what affects the deal, and kind of learn that way with a small passive investment.
My last question for you is how does someone know if the developer is a strong strategic partner?
I mean, you definitely want to look at their track record. So you should be able to see the buildings that they've built, where they are, how many units they've brought to market. A lot of times you can tell by who they're partnering with.
Okay.
If the strategic partner they're working with is a long standing, kind of programmatic relationship. Like the folks that built Avondale, we went to their offices in Chicago. You could tell like they knew what they were doing. So I would say what really will kind of tell the story is when you look at a developer's track record, they tend not to just stay in development. They're doing the same kind of thing that Viking does. Like one of the groups that we work with from a pref equity perspective, they develop properties. That's how they got started.
Mm-hmm.
Now they provide preferred equity. They acquire properties. They'll have multiple divisions because any one of these niches, whether it's development or acquisitions or having a debt fund, or providing preferred equity, they all kind of go hand in hand. And when you can get the full spectrum, you really create the most value for your investors and for your firm.
So would you say that being with somebody who's only a developer is any more advantageous than it is someone who has, all of those pieces?
I would say that working with somebody that's a little bit earlier in their stage, so like, someone that maybe isn't focused on like an institutional level and has had a development company for 15 or 20 years is going to give you more opportunity and higher value to work with them.
Okay.
Most groups that have those different arms no longer need to partner with someone like Viking to bring equity. They're bringing their own equity. They have their own institutional investors. They're working with RIAs. They're actually providing equity because they have too much of it. They're placing it with other groups to acquire more and to develop more.
That makes sense. Okay, cool. Well, any final tidbits that you'd like to share on development and or our current project?
No, I think the big thing is, if anyone's, wanting to learn more about it, me and our asset manager, Ed, took the time to put together a really great review of our pro forma. And he kind of really what he was doing was he was walking me through how everything worked on a multifamily development deal because all of my background has been on hotel development. Kind of knew enough to be dangerous, but really understanding that nuance, it all comes through in that pro forma review. So if you're interested in learning about the deal, even not as a potential investment, but just to learn how someone that's structuring the model has thought about it and how everything works, reach out to us. I'd be happy to send you a copy of it.
Earlier this week, we met with Michael Holman. He's the VP of Overland Group. They are the company that we are partnering with for our development deal in Phoenix, Arizona. This week, we asked Michael about, his perspective of development as the expert. And we're going to go ahead now and take a look at the clip. Hi, everybody. Welcome to Wealth Unfiltered. As I mentioned earlier, we have our special guest here. We have Michael Holman. Welcome to the show.
Thank you.
Michael is the VP for Overland Group, and he is one of the partners that we have for our development that we're doing in Peoria. So, Michael, If you could, please just let us know a little bit about your background, about Overland Group, and basically how we all came about to have this partnership.
Yeah, absolutely. So my role in Overland Group, I run all of the development and financing. We have about 35 employees. We do development and construction, and we're focused in the Utah and Arizona market. So we have offices in both. We currently have about 400 million in development. Roughly 200 million of that's under construction, and 200 million is in pre-construction. So that's just a little bit about who we are. As far as the partnership comes, I've actually known uh, a lot of the principals at Viking Capital. God, it's probably been 3, 4 years ago now at this point. I think the first interaction, if I remember right, was I think Vic. I did a podcast. I did like 50 episodes. I was terrible at it. You're great. I was terrible at the podcasting. But I did a few episodes. Actually, Vic was on it. We chatted. And then we ended up meeting each other at a few different conferences. That's where we met. Lo
Yeah.
and behold, we almost did a deal together 2 years ago. And we kind of started down that path, and for a lot of weird reasons, it just didn't quite work out. But we kind of have stayed in touch ever since. And so I've gotten to know everyone at Viking Capital uh, pretty well over the last 3, 4 years. And I've always wanted to find the right deal to sync up and do together because I think highly of you guys.
Awesome. Yeah, I know that Vic and Chris have been on all the times that I've met with you and all of the conferences, but they speak very highly of you. So I know this is
They
our
just
first
don't
time.
know me that well yet.
This is our first time doing one of these, but you've been on webinars with both of them. You're coming up to do another one in January. So I'm really excited that I get to be the host and actually interacting with you on this time around. So what I wanted to talk about first is the big, big question that's like the elephant in the room that everyone wants to know. How are you, not only with our deal, but how are you in general having $200 million actively being constructed right now when no one else can?
Yeah, I attribute a lot of that to our past. And what I mean by that is we're a company that's been around for 40 years. Um, but man, we are one our culture at Overland is we are really gritty. I mean, I tell people, people often ask me, I'm interviewing and things like that. And they're saying, what's the one word that describes your company? And the one word that I usually say is relentless, right? And so I think that sets the foundation for how we're getting stuff done right now is that attitude and culture. I think the other side of that too, and the piece that really puts it all together is the fact that a lot of development companies in the world are tied to one source of capital, and that's it, right?
Right.
So a lot of developers are born out of a family office where somebody sold a business and they have all this money, and it's like, well, we're going to start doing development now, or they're backed by a single institutional investor. Well, if you look at today's market where a lot of that has dried up, I mean, practically all of it has dried up. The interesting thing about us is we are often very unique in the fact that each deal is a little bit different. We partner with different people. So we have a little bit of diversity in there, which hasn't pigeonholed us to where when somebody in an ivory tower turns off the spigot, we all run around. It's like, well, we're done. Like we don't know what to do. Um, and so I think it's the relentlessness kind of set the stage for us being really good at that. Um, and the fact also that we've had, I mean, you look at our founder, Ken, which is my father, he's been through 4 major recessions dating back to the 1980s.
Wow.
And so we've, from the very beginning, we understand that real estate is cyclical in nature. And so we don't get too aggressive in the good times, and we don't get too scared in the bad times.
Wow. That, first of all, I didn't know that about your dad. And I think that's like insanely cool because that adds a lot of clarity for people who say, well, why you? And what is it you're doing that's so different? But if somebody has that track record of, so many recessions and understands how it works, then you guys can set yourself up for real accomplishment and being able to really ride the wave and make sure that everything that's going on is like kept in order. Because I would say the fear, right? That's the biggest thing is the fear. when investors come to us and they say, why would I get in a development deal? There's so many risks, right? Let's talk about the risks here. So one of the major risks is what happens if I put my money in and then they can't construct the deal, right? So what about that piece do you feel like you can offer investors to say, well, we do this different, or this is why we don't feel like that is one of our risks?
Yeah, yeah. I always kind of laugh when people say development is risky, right? Because I get why people say that, right?
Yeah.
But when you're a developer and you're in it, people don't realize that every move that we make, we already 99% of the time I know the answer before I go do the really risky thing that people
Right.
often say, right? Like when I'm going to entitlements, I have, I mean, it doesn't always work out this way, right? But most of the time, I have talked to every single city council member. I've talked to every single planning and zoning commission. I've talked to all the planning and staff. They can change their minds, but I pretty much know what they're going to say when I go in there,
Right.
right? And if they're going to say no, I never go in. Anyway, the reality there on, that risk of development, the key here is about the timing, right? If you look back when, say 2022, right? Money was flowing, everybody was making investments, and people were putting in money honestly too early into deals. And that's one of the things is like on a development deal. And I'm not saying it's bad, right? I mean, we did it as well. That being said, the people who put money in early were compensated for that risk.
Right.
But you look at like the deal that we're doing together, Peoria, that deal, money isn't coming in. I mean, we're from the day that we're recording this, we're only a few weeks away from having the building permit, right? We're entitled. There's no entitlement risk. The city can't come back and say you can't build this. We are weeks away. We've already had first comments on the building permit. We're just a few weeks away from having that, which means we've already started the lending. I mean, we're literally just within a few months of putting a shovel in the ground. We've eliminated basically all of the risks with the entitlement and pre-construction phase of a development, right? That's gone. And that money doesn't come in until all that risk is gone. Now, when you get onto the construction side, you say, well, how do I know the project is going to get constructed? By the time you put your money in, honestly, there's like the only way that the project isn't going to get constructed is if some funny business is happening. Because when that money comes in, only 1 or 2 months before the construction starts, I mean, we already have, I mean, you look at Overland, we've spent millions of dollars in
Right.
Peoria to date, right? Like, so one, we're highly motivated to ensure that this project happens, right? Number two, we own the construction company.
I was
right?
just going to say that. I was like, that's what makes you guys special too, I think. And that kind of mitigates some of that risk.
Absolutely. Because you think about it, our construction team, right? I have a pre-con operations, I am in constant communication. My development team and my construction team, we talk all the time about these projects, right? They bid it out and talked to subs when it was just a concept 2 years ago. They talked and bid it out, and we went to them when we had just schematic drawings or just like floor plans. I mean, all the way up until the most recent one is we have a full bid with a lot of input from every single major sub when the construction drawings or the architectural plans were 60% complete. You know what I mean? And so it's like every step along the way, we always go back to construction to validate costs, timing, everything like that, because we want that input. I mean, at the end of the day, their piece of the development is a pretty big piece. It's not the only piece, but from a cost standpoint, it's the largest piece of the entire capitalization of a project. And so that really mitigates that. I mean, at that point, we have everything locked down. We have the general contractor, their contract is locked down. All our engineers, architects, everything is locked down. The plans are already done. We already have every single approval from the city. I mean, it's just performance. It's just executing on the construction side, one of which we feel pretty good about.
Right. As you should with your track record. So one of the pieces that I wanted to ask you about as well. So just like any acquisition for development, before you guys can even buy the land, you guys have to vet out where you want the the actual location to be. So what goes into your process, or are you the one doing it? And how do you guys find an up and coming like market or someplace where you know that this is going to be successful?
Yeah, that's a great question. And a lot of it has to do with what's around in the area, right? And so the things that we're mainly looking for us, we are very interested and we target highly trafficked areas. We want something that is close to transportation and major exits. So I mean, we like currently we have two other multifamily development deals that are under construction in Arizona right now, right? And
I've been to
Peoria,
one of
perfect,
them.
perfect. If you look at where those are located, right, in proximity to major roads, freeways, Peoria is very similar. Peoria is a little further away from a freeway entrance, but you are right on the major highway that you're 20-25 minutes to downtown Phoenix,
Right.
right? You get on that highway, you don't move. And so that is one big key factor for us is we want to make sure that because the reality is when you're living in an apartment, and especially as Arizona has been interesting in the fact that it's become a lot less affordable over the last few years, right? Ever since you had all the inflation, you have homes skyrocket, affordability is a major factor, right? And so right now, um, me myself, I would be fearful of, class A plus high rise. I mean, I have a high rise in the downtown area that I've had planned for 2 years that I'm actually switching and adjusting to try and make it more affordable to people because that's what works for me. That's what penciling for me, right? And so you have to, when we go to the outskirts, you got to be able to have people are still working in Phoenix. It's not like every single job has spread out. I mean, you got more remote work, so that transportation is key. We're looking for to be on the level of affordability, meaning that we're trying to hit a mass target demographic
Mhm.
for what we build. We are class A, but basically any new build you build at this point is going to be class A. But
Right.
we like to call ourselves affordable class A, right? It's nice. It's nice amenities. It's a class A plus amenity package, and it's a class B plus unit layout, right? We're not doing big grand units. We're trying to make those affordable. So location is huge, right? Especially on the transportation side. Um, Understanding the demographic and what they can afford, right? For example, like our location in Peoria, I would never build something that I would build in downtown Salt Lake or Scottsdale or something like that. I wouldn't put that in Peoria,
No.
right?
Well, also
First
I
off,
noticed in Peoria there isn't a ton of Class A anything. Like really, like the what's surrounding you is like from like the 80s. Like there
yes,
there's nothing new there.
yes, exactly. And then the last component is we want to make sure it's really that almost that qualitative part where we're looking at shopping, retail, what's around the property, right? It doesn't have to be. I mean, we're not looking to always be next to a shopping mall. I mean, I think of the project you visited probably when we bought it, it was farmland. But what we're looking at is not just what's there immediately, but what is coming down the pipeline, right? And if you look at like Peoria, our plot of land used to be a grocery store, a really old grocery store that they demolished. So you have this one vacant property and you have redevelopment happening all around. I mean, the city just built a brand new art center next to us. They have all sorts of plans to purchase more land and try and copy a little bit of kind of what like downtown Gilbert is. It'll be a heavy lift, but I'm excited for the vision that they have there. And so seeing that it's almost like an infill site without being an infill site, you see stuff getting redone, recreated, developed. That trajectory is what we need, right? Because as a developer, we're not thinking just about the here and now. It's what is this going to look like in 3 or 4 or 5 years from now when we look to exit the property?
Absolutely. So, speaking of timelines, that actually takes me to my next point. So, one of the things that I think it's hard if investors have the mindset that they're looking for an acquisition because in their minds, they're like looking for the track record of what's already going on. How are things happening? But in new development, you have to have like a long mindset. It's 2 years till this thing's going to be completed. And then when that happens, that's when you're looking for the stability. So, kind of what you're talking about, it doesn't really matter what's happening right now. It's really what's going to be happening. Is it gentrifying? What's going on? Is the city pouring money into the area? So what we're seeing in the economy is that most people are having trouble building. This is probably one of the lowest years that we're going to see starts happening. So my question to you is, how do you see this as a benefit to invest now in development versus back in 2022 or in a time when this was a lot more competitive?
Yeah. That's actually a pretty easy answer in the fact that it goes back to what I said earlier, right? A lot of development historically has been driven by institutional investors, big companies that write 20, 30, $40 million checks to a developer who goes and builds the project, right? Well, interestingly enough, right, they were all going gangbusters. 2021, 2022, couldn't get enough. Life's good. There's no way to lose money in multifamily, and pour it in, right? And now all of them all of a sudden are realizing, oh my goodness, like maybe some of those decisions weren't, the most prudent decisions. So now they scaled all the way back. Well, I mean, it just goes back. What's that, that age old adage of investing, right? Be greedy when others are fearful, and fearful when others are greedy. So it's interesting because I don't mean to go into supply. I mean, so
No, I
that
love
is
it.
the short answer, because I got a whole slew of supply demand to go into. I
I
got
love
a whole
that
bunch of
though.
stuff.
Yeah.
So I'm going to go right into it,
Okay.
Samantha. And you can stop me at any point. I just get excited. So when you look at this, right, we track what has been delivered, right? The new apartments that have been developed and completed, and what is projected in the future.
Mhm.
And we can project that because it takes, I mean, you look at Peoria, we went under contract for Peoria 3 years ago, 3 years ago. I mean, we've owned it for over a year, for like a year and a half, 2 years, right? We've been working on this project for years. And you can see through what people are doing with the city and submittals and things like that, we can project out what is happening in the future, right? Even CoStar aggregates that data and makes it really easy to see.
Right.
Well, surprise, surprise, everyone who invested in new development in 2022, that's all being delivered in 2024 and 2025.
Right.
2023 through 2025, a lot of deliveries. By the end of 2025, it goes to basically zero, right? And so interestingly enough, point one is from 2025 on, you basically have zero new deliveries. Okay, so you're thinking, all right, there's no new deliveries. Okay, everything gets absorbed. That's great. Well, that by itself isn't the key. The key is part two. You look at Arizona, right? Utah's very similar. Look at Arizona. Arizona, based on their state housing department, is short an estimated 270,000 housing units in the state.
Wow.
Right? So you think about that, and now it starts making sense, right? You did have a glut of supply 2023, 2024. Understood, right? Like that happens. Never mind that rents didn't really go down all that much. You had to increase concessions, don't get me wrong, but stuff's still filling up. But you combine the fact with long term, over you look at this from a macro level, we're 270,000 units short. We have a housing problem that probably can only be solved by increasing the number of housing units. Like that's the number one factor there, right? So you have that at a macro level. Then you start looking at it at a micro level saying, okay, we know this problem exists. We know immigration is happening like crazy still. People are still coming from California, Illinois, New York, and you have zero new housing units coming online in 2020, at the end of 2025 and beyond, right? You can start to see where the issue arises, right? And so from like an investor standpoint, that's why we have a lot of conviction right now in starting new projects, because we forecast that. We look at that and it's like, the nice thing about us is we're a family-owned company. We don't report to an investment committee, right? We don't have a board of directors and an investment committee who, you always want to say those guys act rationally, right? But they're driven by who they end up reporting to. Right. You know what I mean? And so those spigots just turn on and off, and they always turn off at the worst time and they turn on at the worst time. You know what I mean? They don't listen to that old adage. They want to invest when everyone else is investing, and then they stop when everybody stops. And so you look at all of that combined as a whole, and you're saying, wow, Arizona's got a huge problem. Utah's a very similar situation. Utah's got the same problem as well. We need more housing. it solves multiple issues. Like we need it now, but we
Right.
also need it to solve affordability issues going forward. And yet the economic environment in the here and now, right, has stopped developers and investors from moving forward, which is going to create a huge issue, right, going forward. I mean, I'm not going to say we're recreating like the 2019 to 2022 era, but how many people when they developed, I mean, I have a development that started in 2019. I can tell you by the time it completed in 2021, I didn't expect it to be worth like triple what it was, right? But it almost feels like some of those fundamentals haven't changed. And so that's why I'm so passionate about this, because when you look at it and you take a step back and you actually see like what is happening from just an in-migration population affordability, like what's important to the world, um, building right now or starting right now makes all the sense in the world. Not only because it solves major issues, but also it provides a lot of economic opportunity for those who are willing to take that conviction and be greedy when the rest of the world is fearful.
Yeah, I think that's also why Viking felt like this was the right time to start our very first development deal. Like this is the moment to do that. Another thing I was actually reading was that last year, 2023, Arizona was fifth in the nation for in-migration, domestic migration. So I mean, it speaks exactly to what you're talking about. The numbers don't lie, the statistics don't lie, and the fact is, it's like just the Phoenix area grew, but I mean, all of Phoenix. I mean, it's just getting bigger and bigger and bigger. And actually, it's getting better too.
Yeah, no, it's so true, and it's interesting because you can kind of say, people always want to point back and say, oh, well, it was COVID, right? Everyone could work from home, so everyone just moved from California. Yeah, that expedited it. Don't get me wrong, like that definitely played an influence. But this immigration was happening before COVID, and it's still happening after COVID. Like Maricopa County at this point, it's been in the top 5 for fastest growing counties by population for like 9 years in a row.
Yeah.
And I think for 4 or 5 of those years, it was number 1 in the nation as the fastest growing county by population, right? And so this is a long-term trend that has really like solidified. This isn't like this isn't a short-term, fashion trend that's going to come and go in a couple of years. This has been happening for a long time, and everything is showing that it's going to continue to happen going forward.
Yeah, absolutely. Well, I don't want to take any more of your time, but I will say if there's any last like advice or anything that you think is like, we should know this special tip about development, like this is your moment.
Yeah, so here's what I'll say about development. And I love, obviously I'm biased. I love development, right? But the thing that that people most often when they start, because we have done a lot of joint ventures. We have worked with a lot of investors who have mainly done value add, right? I mean, we have hundreds and hundreds of people that have invested with us, and a significant portion of them, we've been one of their first, if not their first developments. And what you always have to know and understand about development, right, is development is focused so much on value creation, right? Which exists in value add, don't get me wrong, but it's impossible to replicate the value creation of taking something from a piece of dirt to a completed brand new property, right? Like that is really important to know and understand. And so a lot of times I get conversations where it's like, well, what's the cash flow? What's the cash flow? What's the cash flow?
Yes. Oh, I'm glad you brought that up. I meant to talk to you about that.
I always just want to like give the investor I'm talking to a big hug and just say, we're all concerned about what the cash flow is. We're talking 5-6% on a good performing multifamily property right now. Like, don't get me wrong, that's great. But the property you visited in Arizona, when we started construction, right, that project, at the same time we got an appraisal for when it was going to be complete, we're talking a $50 million difference between what it costs us to what the value is upon stabilization, right? And so I always kind of want to just like talk to people and be like, don't get me wrong, like I love cash flow, but if you had an investment that was going to increase that much right? Like, wouldn't that be more appealing than getting a smaller piece of cash flow, for the first year or two? And everyone's like, well, yeah, of course. And it's like, that's
Gotta play the long game.
kind of what I'm talking about here, And so that's the interesting part about development. I mean, and every big real estate company that's out there, right? They all have development in their portfolio because it provides the highest level returns. And if you're smart about it, you partner with good experienced people who know what they're doing. It definitely has the potential and opportunity to provide the highest returns. And most people get burned when they deal with inexperienced people, right? It's when your neighbor down the street decides that he's going to go develop a 1-acre property somewhere in town and convince you to give him $100,000, right? Like, don't get me wrong, I'm not saying you should never do that, but like, that's I've talked to time and time again, and almost every person who tells me, I put money in this development, it didn't happen, it's because they went with someone like that. And that's, I mean, the operator and the developer and the general partner team is the key here, to making sure that you're successful in a development investment.
Absolutely. I mean, and that goes for acquisition as well. Having a strong track record and being with people who really understand the name of the game and what they're doing, instead of having it maybe just be word of mouth, like doing your due diligence. I mean, all of that's super important. So I want to say thank you for joining us on Wealth Unfiltered, and hopefully I'll be seeing you soon. But I know that Chris will be, because he'll be on the webinar with you on January 8th.
Awesome. Excited for it.
Awesome. Thank you so much. I appreciate it.
Awesome. And on that note, we also have a webinar for this specific deal. So if you want to learn more about Overland Group and our relationship, the specific deal, even Phoenix as a marketplace, we're going to be talking about all of those things. The live webinar is going to be going on. Chris will be there. Michael Holman will be there as well. And that's going to be January 8th. And I believe it's the same day that this podcast will go live. So tonight, everybody watch tonight. Check out our website. Click, make sure you guys join. And that will be it for us. I hope you enjoyed. Thank you, Michael Holman, for joining us on our podcast. And we look forward to seeing you on the webinar as well.
Thanks, everybody. See you next time.
Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.